Good afternoon. This is Capital Link. I am your host for today's interview. My name is Lambros Papaeconomou, and we have today with us Mr. Marco Fiori, Chief Executive Officer of D'Amico International Shipping. Mr.
Hi,
Fiori,
Lambros. Thank you very much.
Welcome to New York and Capital Link.
Thank you. We've been talking a lot in the past, and it's good to have this together.
Pleasure is all mine. Mr. Fiori, your company specializes in transportation services for refined products.
Yep.
You currently control a fleet of 55 vessels.
Mm-hmm.
Now, before we have the chance to talk about your company in particular and your commercial strategy, I would like to have your views on the market.
Okay.
And I would like to start with the demand side and what is your outlook?
Okay. Thank you. Now, the 55 ships, as you said, product tankers, and you said refined products, I would like a little bit to expand that. Product tankers are coated ships, and so they have a lot of flexibility. They don't do only refined products, we do also easy chemicals, because most of our ships are also IMO 3, and we can also do veg oils. So there is a very broad spectrum of products you can carry. I must say that in general, this flexibility is one of the reasons that the market, especially in our main segment, which is the MRs, the medium range ships, it's a segment that has volatility, but not huge swings of volatility, especially downwards volatility, because in general it is a very flexible ship. The MR can carry enormous quantity of different things, as we discussed, and therefore there is always a ship where there is always a need. The main segment of the MRs is a fleet about 1,500 ships running. It's kind of a young fleet. There's been, I think the average age is around 10 years, so they're starting to get a little bit older. And we have a very young fleet in this average young fleet, because we have just over 7 years of age. Then we have some handies, which are the smaller ships, which is a smaller fleet worldwide also, and especially mainly used in the Med, Northern Europe, and was used also a lot in the Caribbean, now a little bit less, but still used a lot in the Caribbean. And then the next size up, so you have the handies, the Mars, the next size one is what you call the LR1, which in crude would be a Panamax, and when they're coated, it's called an LR1, long range one. And then you have the bigger ships, that the LR2s, which in crude are called the Aframaxes, and then you go up, and that's then more or less of the coated ships. There is some LR3s, but they're very few and very specialized. So this is the market. Now you were asking about the market. The market, we've been very bullish for a certain period of time, especially I've been very bullish for a certain period of time, because I have seen a lot of positive fundamentals falling in the right place. We've seen deliveries. We had a lot of deliveries in the past, but now they've been tapering down. Shipyards are consolidating, and there's not many yards who can build coated ships like products. So we are a little bit a niche in a niche. So because already you can build. There's not a lot of yards can build tankers, much less than dry cargo ships, are much easier to build. But within the tankers space, coated ships, there is a little bit more of technology involved. First of all, because you have a lot of different, you can carry different cargoes within the same ship. Mm-hmm. In a crude tanker is all the same cargo, more or less. And then you have the coating aspect, which is an added level of specialization of the shipyard, because it is a kind of a coat of epoxy, different coatings for different products, and so that implies also a higher specification. So deliveries have been going down, new orders have not been there dramatically there. Inventories, the last spike we had was in summer of 2015, when price of oil started going down dramatically. That was very good for the products. We had a very strong summer, which normally is not the case. Summer is kind of a dead period, or a slower period. And since then, the market started sliding down. But you know, as I said, because there was a lot of inventories generated in that sudden decrease of oil, because refineries had margin widening dramatically. They were refining everything they could. Demand at the retail level was not there, so they had stocking and stocking and stocking. So we went through a big stock up process, but which is coming down again. So deliveries, stocking, and then they're getting ready in the future. I think now you have some big changes in regulation. We can talk later on about 2020 about the low sulfur. So that will imply a little bit of big change in the logistics and everything. So for me, the fundamentals are there, have been there for a while. We have not seen the market responding to these fundamentals, but I also believe that every day that goes by, you get one day closer to a big pickup. So, you know, I think it's a matter of
as we like to call the inflection point,
absolutely,
which is probably nearer than.
I think probably we are in it, or it's already behind the inflection point.
When you look at the demand for refined products, because when it comes to transportation, there are two factors. First of all, the demand per se, and the second factor is the distance that you need to travel. How do you see the new refining capacity that is coming along affecting demand for product carriers?
Well, I think that the new refining capacity has been following the old refining capacity, in the sense that what was the trend? I think growth in products has been, in the last 10-15 years, has been an average growth of 4% year on year. Refining, since many years, has started moving out of Europe, because we changed completely model. We were in a model where you were extracting the crude, putting it on crude tankers, moving it to the places of refining that was close to the consumer, and then distributing by truck, by rail, by everything by short distance. I think the oil-producing countries made some big investments, and also some other Asian countries, in refining, because they wanted to catch some added value for remaining in the production chain a little bit more. So today you have a model which has changed dramatically in the last 10-15 years, in which you have the refining that's getting very close to the extraction point. So what was carried as crude, more and more is carried as products to be refined. There is big investment still continuing there. New refineries are coming online. And I think that instead in Europe, especially in Europe, is dramatically falling off all the refining. It is expensive. It is not a very clean industry, so people don't want to have it anymore. I think mainly this process of reduction of refining in Europe probably has been slowed down by social reasons, for unemployment reasons. But I think as things move on, this will impact less and less. So we'll see more and more of what was transported in crude being transported in products. So there's been a lengthening of what we call the ton mile, as you correctly said. So, and I think this is extremely beneficial also for the industry. So you have also ton mile effect, which is going to be playing a good role.
So in other words, the position of the new refineries, that we should call them export refineries, is a secular trend for ton-mile demand.
Absolutely,
for
extending, yes. And then we have it also in other countries. For example, China has started big refining capacity also in China, and contemporarily in the Asian region, you had countries like Australia would have cut down almost completely all refining activities. So now we have a lot of things are moving to Australia as products. They're still being moved out of Singapore, and the Chinese are exporting to Singapore. But if we start seeing a little bit more of export on longer routes from Chinese refineries and things like that, that will be also another big addition to ton mile.
Mr. Fiori, I would like to ask you about the U.S. The U.S. is becoming again a very important energy hub, obviously with shale oil production, both on the import side and the export side now. To what extent all this is affecting the trade flows for refined products?
I think that the U.S. had two very distinct moments. The moment before the actual presidency, where crude oil was considered a strategic resource and was not allowed to be exported. So you had only export of products, which was good for us. Then there's been a change. Now you can export also crude. That made the US, with the shale oil increase of discoveries, made the US being one of the largest countries exporting or producing oil. For sure, we're going to see exports of crude. But at the same time, I must say that Americans have been very active in increasing their refining capacity, very modern refineries, and this has matched also the fact that now we have a little bit more of a global recovery. You have South America, for example, which is starting to absorb a lot, and all of those products where they have not been expanding refining capacity in South America and Central America is coming mainly from the US. So that's a captive market for the US. You have also some transatlantic voyages from the US to some African countries like Nigeria, because they don't have the refining capacity. So at the end of the day, products go where they have to be consumed. And if you don't build refineries, those are the countries. And we see a lot of these countries. We see Africa, South, Central America, and Asia. There are countries that are growing at higher rates than the rest of the world. So it is a good for the demand, because these countries are growing dramatically.
The shipping industry is going to have to adapt to some new regulations, one of which is the new emission standards set by the International Maritime Organization, IMO, as of January 1st, 2020. Now, the industry in general has to comply with the new fuel requirements, but when it comes to product tankers, there is a different aspect to this, because the new compliant fuel, which will be now the primary bunkering fuel, has to be stored, has to be placed in bunkering ports around the world. So how is this going to affect demand for product tankers?
First of all, I would like to say that normally the shipping industry in general, it is very sensitive to regulatory changes. Normally, shipping has always been affected positively when there's been big regulatory changes, like happened for OPA 90, the double hull. So I think this is another case of that happening again. As you say correctly, there's going to be very large, enormous logistical problems, which should benefit the product tankers. Why? First of all, the first logistical problem is that not all the refineries will be able to produce low sulfur fuel. So there's only few and specialized refineries will be producing this, so they'll have to distribute this product all over the different ports of the world. At the end of the day, you have mainly two solutions here for going forward after 2020. Either you load on board, because IMO was very clear, and I think they made a very clear law in which only ships that are equipped with scrubbers will be able to have on board heavy fuel. So that doesn't leave much room for interpretation. So if you have a scrubber, you can have the heavy fuel. You don't have a scrubber, you have to have low sulfur. So I think scrubbers have been starting to be installed, manufactured. I think that people on scrubbers have a lot of different opinions. There's going to be a moment which there's going to be a big delta between the low sulfur and the high sulfur fuel. But then on the other hand, scrubbers, there's only a limited number of scrubbers. I think by 2020, probably in the thousands, they'll be available or equipped on ships. There is some limitations. Bigger ships, like big container carriers, VLs, they have bigger consumption, so much more sense than smaller ships, MRs and Handys, and also LR1s. There is more limited consumption. So scrubbers won't be many available, mainly will be going on the larger ships. So what everybody else will have to do, everybody else will have to buy low sulfur fuel. So I think there's going to be a logistical problem of the fuel refineries that manufacture it to distribute it. And then, there's going to be a problem also of storage, but this is we're less concerned because every port where you had one storage facility for the same thing for ships. Now we have two, one for the heavy sulfur,
right,
the people with scrubbers, and one with low sulfur with the people without scrubbers. So it's going to be a big logistical nightmare. As far as product tankers, we think is a great opportunity because we have a great ton mile increase, and then we'll have to transport these new products. Will be really a big change in the dynamics of the whole market. Also for refineries, because people seem not to realize that for refineries to make low sulfur fuel, it is very important the type of crude they also get. Because if you begin with a light crude with low sulfur levels, it is much easier for them to make low sulfur. So it's going to be also a reshuffling of which crude is coming from where to there, and then distributing the products from there. I think it's going to be a big change for a lot of things. And normally these type of changes are very beneficial for the industry.
As you astutely said, because ship owners are there to carry cargo on demand, and there will be the additional demand.
And be the additional demand, and then at the end of the day, when we are a little bit, the product tankers is the connection between how to make imperfection. You'll have arbitrage opening up, so we'll be there to correct these inefficiencies in the market. Will be there, and there's going to be a lot of inefficiencies in this market.
So speaking of arbitrage and trading opportunities, I would like to ask you about your chartering strategy. In my introductory comments, I said that you control 55 vessels, and that includes the vessels that you own, but also vessels that you have on time charter, either long term or short term.
Absolutely.
So can you please tell us a little more about your commercial strategy?
Well, the commercial side is very simple. We believe very much in critical mass, because I think that having a certain critical mass to be a big player, it's an important factor. How you obtain critical mass, you can obtain it by participating in pools or chartering in tonnage. So we've been doing owning tonnage and chartering tonnage. We try to keep, depending on the market, which moment of the cycle you are, we try to keep more or less a 50-50 that can shift from one. Now we're more or less at 50-50 on this. Our TC book in this moment is around 30%. We have always said that we like to have a TC book that is between 40 and 60%. But then we've always been very clear in this aspect and say we want to be at 40% at the bottom of the market. So when the market goes up, we have tonnage to put out a TC. And when we feel the market has stopped, we would like to be at the 60-70% because we've locked in a lot of ships. So now, having told you that we are not in a very positive market and we are in the 30%, I think we've been very consistent with our strategy. We always felt that not the time to do long-term charters and to lock in at these rates. So that's why probably now we have a lower coverage in our market. Naturally, we have clients, and I would call them partners more than clients, like the big oil majors, the big traders. Naturally, when these counterparts come to us to charter ships, so they want to do a long-term TC, and they have our opposite interest. They want to come in a lower market to lock in. We can't tell them no. We are here in this. That's why I call them partners. We're in this in the long term. So good times, bad times, we're both of us in this market together. So naturally, when these counterparts come to us, we're very happy to satisfy their needs and to find a compromise to also give out some long-term TCs. That's why we still have a 30% time charter, and recently we've been doing some new TCs with some oil majors and some trading companies, because we feel that once you're partners, you cannot be selfish and look at your own interest when the market is in one direction. You have always to find a compromise with that.
So you have a fleet that is 50% on, 50% time charter.
More or less, yeah.
When it comes to period versus spot, you try to have a combination between 40 and 60%. Right now you are at the low end, 30% time charter,
Absolutely.
Anticipating a recovery. There's another trend that I noticed looking at your fleet, is that now you have 4 vessels that are on bareboat charter. These are the sale and leaseback transactions. which is, if you look at it, another form of finance.
Absolutely.
Would you like to tell us the rationale behind it?
Yeah, I think we started doing this a little bit a while ago, mainly driven by two things. As you said, it's financing. Normally, you'll see that there is some more modern ships, but mainly there's also older ships that we try to do on these things.
Mm-hmm.
Because when you wanted to sell ships, there was less liquid in the market for many reasons. Financing less available to second-tier owners. So we had to find something creative in order also to dismiss older ships, but also to create the liquidity. We had a big new building program. We have now the last part of the new building program. It is 4 LRs. We have 2 in delivery in the summer and 2 in delivery next year. And the market has not been there to generate the cash flow to take delivery of this. They're all financed. We have commitment for financing, but then we need also liquidity as to put our equity portion, and liquidity also to keep in the market, to be in a comfortable position. We don't want to be in a tight position. So we had to do some, we envisioned to do some sale and leasebacks. Last year we also did a capital raising, which was followed by some which during the capital raising there was some warrants to be issued, and our controlling shareholders exercised those warrants as a way of putting also more equity in the company. So we look at different ways of keeping this liquidity going. But you're right, sale and TCs, they're very much financial transaction. We have been very active. We want to go into specific of these, with one exception of a Norwegian TC that we were very happy to do, but we did most of them in Japan. We have a position consolidated in Japan for the last 20, 25 years, very strong account. We do a lot of TCNs long-term with Japanese companies, Japanese owners. We are recognized with some other few companies as primary counterparts for Japanese. And Japanese, for fiscal reasons and also for other reasons of increasing the fleet, have been very happy to do long-term acquisition with long-term bareboat. But the key here is why we did it. First of all, the cost has been very limited. If you talk to everybody in the financial industry, they say the Japanese have been really the people providing the lower cost capital in the industry.
Yes.
We're talking about 6.5% for 100% financing. So between 6.5% and 7%, which is incredible numbers. And second reason, when you do this long-term transaction with Japanese, starting from the second, third year, you have some purchase option on the ships that you've been selling. So for somebody who wants to keep a critical mass, wants to improve temporarily liquidity, believes in the market recovery, this is the best way of doing all of the above, because you're selling the ships, you're generating liquidity, it comes back to you at a very low break even, and at the same time you have the possibility of repurchasing back those ships.
And of course these options have a lot of value.
And these options, they have a lot of value, especially if they go in the money, they have a lot of value. And it's not that the option value is calculated like that. You start from the price of the ship now, you depreciate it probably in 10 years down to a certain value, and then it is a mathematical calculation going down. So, there could be a lot of value in these options.
It could be. What is your view on, because this alternative type of, we can describe sale and leaseback deals as the primary alternative type for financing. Do you expect this alternative finance to gain more market share in shipping in the coming years?
Well, I think it will gain more market share, if we continue with the certain trends that you have today, such as banks less willing to finance pulling out of shipping. And on this note, I must say that we're also very lucky on this, because I think that banks have concentrated more on primary accounts, which is very good for us, because what happens that it's like, if you can imagine, a pie that's been shrinking, but the slices of the pie are getting bigger. So there's few people which they're concentrating on, and we were lucky among those. So we have a lot of alternatives in the bank world. But unfortunately, a lot of people are not in our situation, so they'll have to find alternatives way of financing. So this probably could be a solution for that. and you have a lot of Japanese. Probably it's difficult unless you know the market, but for sure there's a lot of people in the United States, Scandinavia, and China which are very active on this, with depending, like everything is.
Your company is listed in Borsa Italiana,
Yeah.
in stock exchange in Milan. Some of your counterparties are here in New York.
Absolutely.
There is a possibility that we are going to see shipping IPOs again very soon. What is your view of capital markets and shipping, particularly in the United States?
Well, I think that everything has to be, we are in Italy because we are an Italian company. We feel we have good liquidity in Milan. On the negative side, for sure, we're the only shipping company listed in Milan, so there is a lack of peers. Then in the States, instead, I think you have a very efficient market. It is a more expensive process to list and to keep your listing in the United States, but that can be overcome by the fact that if you have a large listing, if you're large enough, then you can have some economies of scale, which is good for a US listing. Then in between the two, you have the Oslo market, which it is a very fast market to list in. A lot of the American participants are participating also in Oslo, but doesn't have the scale and probably the scale and the liquidity of the New York market. So I think these are the two main alternatives that you would have to a company who's in Europe and was thinking about listing. I think you have your local market, Oslo or New York. And actually New York is the most expensive, but in exchange to that you have huge liquidity. You have, if you really want to run a public company and have access to capital market funds, I think the New York is still the place where you can do it in the most efficient way. Then you have Oslo, which gives you the advantage of the speed of listing, and in shipping it is very much finding a right window of opportunity of being able to list. So in Oslo you can overcome that because it's a very fast way to, I think in 3 months, 4 months you can do a listing. So if you see a window that's opening, Oslo probably is the fastest way of listing.
When you look at a company like D'Amico, you have about $1 billion in assets. Your book equity is about $400 million. Your current market capitalization, I believe, is about $175 to $200 million. If not D'Amico specifically, a company that size, can it list today in Oslo? Can it list today in New York?
Oh, I think they can. They have the world of opportunities. They have where we are in Milan, which we are reasonably happy about our Milan listing. Oslo is a very simple process, and then if you have really, if you want, we are already of a size where we could also think about a U.S. listing. Then there is also some other considerations that we've been in Milan for 10 years. It's kind of a process which we're happy where we are. But I think if it's not D'Amico, a company like D'Amico with a clear view on growing, I think the United States is also not a perfect alternative.
The product market, according to to many analysts, I should say, is the market that should be the first to recover in the tanker sector. The fundamentals, as you explained, are ready, and we may already be past the inflection point.
Sure.
If we were to have this conversation a year from now, which market do you think that we will have?
I'm sure will be a better market. Then it's very difficult to tell you in dollars and cents. I'm sure will be a better market. Also because what I was telling you about 2020, the IMO new rules are based on January 1st, 2020. So what people should be very aware that it's not that we're going to go to bed on December 31st. Relaxed, and then we wake January 1st and everything has changed automatically. All of this implementation, moving these new products, making it ready, is something we start before. Also because ships will have to load the bunker. For ships who have to low sulfur bunker, you need some time before. You have to load it. You have to use it at least once or twice in order to lower and clean all your bunker tanks. So it's a process that will start way above. It's not December 31st, January 1st. So if we're talking 1 year from now, will be January 2019. June 2019. I think will be a much better market.
It will be a very busy year.
It will be a very busy year. Everybody's scrambling to get ready, and you know, there's people who plan ahead, and there's people who plan less ahead, and they're all running around to catch up. I think 19 will be a very busy.
And I am sure that you have fresh the memory of when Italy was converting from the Italian lira to euro, and that all happened on a set day. But banks had to prepare well in advance.
I can tell you something very funny. On that day, I think was the 1st of January that happened. So you have December 31st, you have night out, you stay up late to see the new year. And I think at midnight plus 15 minutes, I went to a bank at a cash machine to pull out the euros to see if everybody was ready. And I got my euros. And not
to see how they look like. Well, Mr. Fiori, it was a pleasure. Thank you very much for this interview.
Thank you very much.
I wish all the best to you and your
Lambros,
company.
and thank you very much for you. It's always been a pleasure. And you know, what we do in D'Amico, we pride ourselves being always a very flexible company for our partners, our clients, which we call partners, and also investors, analysts. So we're always available for discussion and trying to improve things. Thank you very much.
Thank you.
Thank you.